Hey investors, Bradley here from Watson Estates, and you're listening to the largest, fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. And outside of our ongoing updates, we love to bring you the best guests, and we have a wonderful one here today. Paul Moore is here. He has quite a long resume, but doesn't need a resume. And just to give you some insight, he's a contributor to the Bigger Pockets podcast. He also is on Fox Business. Further, he's been involved in 85 real estate investments and exits. He's been featured on HGTV's Househunters. And he is also an author of The Perfect Investment, Creating Enduring Wealth from the Historic Shift to Multifamily Housing. And he's also a co-host of the wealth building podcast called How to Lose Money. And he's been featured in over 150 other podcasts. He's a busy guy, and we're so thankful to have him here today. I think you're going to enjoy this show. Hi, Paul. How you doing?
Great, Bradley. How are you doing?
I'm doing wonderful. Thank you for taking time. I know you're a really busy guy. I appreciate you making time for us here up in Canada.
Absolutely. Well, I love Canada. You know, I was always fascinated by Canada as a kid. I always dreamed of going there. And when I was in college, I made a couple trips to Toronto, was amazed by the city. And my son and I now have taken 7 trips to go fishing in Northwest Ontario. So we love your country.
Well, there you go. And doors always open here.
Good.
So we can go anywhere with this conversation because our interest as far as real estate and understanding multifamily, we have a very large audience of people who are heavily invested in across the GTA, and I'm sure many of them in the States too. So I'd love to maybe start our conversation. We can talk a little bit about multifamily. Actually, before we go there, let's tell our audience a little bit about yourself. Let's because they're not going to recognize just how significant your investments have been in multifamily.
Oh, well, yeah. So I had an engineering degree, then an MBA, started my own company. And then I sold it in Detroit. And 1997, I was 33. I had a couple $1 million in my bank account and no sense, apparently, because I actually viewed myself, I started a nonprofit organization and I viewed myself as a full-time investor, but I actually was more of a full-time speculator. And I didn't know the difference between investing and speculation. And so for years, I would make a lot of money on a deal and then I would lose a lot of money on like 3 deals. Mm-hmm. You know, investing is when your principal is generally safe, Bradley, and you've got a chance to make a return. And investing is usually attached to a cash flow stream. Speculating is when your principal is not at all safe and not attached to a cash flow stream, and you've got a chance to make a return. And I didn't know the difference. So when I flushed, $100,000 to the bottom of a hole in North Dakota, I was expecting 100 times as much oil to come back. That was definitely speculating. And when I invested with a guy in Charlotte, North Carolina, who had this special way of making 3% a month, and he turned out to be a scammer, and he's in jail. He's in year 18 of being in jail now. I was definitely speculating, even though he advertised this cash flow that came with this. I was, not really doing the due diligence I should have. And so, over the years, I learned the difference between investing and speculating, and ended up flipping a bunch of homes, then flipping a bunch of waterfront lots at a lake in the area, and then eventually got into multifamily, and I've never looked back since there.
Yeah, and just to fill in the blanks too. So you have, from what I've understood, you have done things you've actually developed hotels. You've rehabbed and managed dozens of rental properties. You've built homes. You've developed even subdivisions. So why multifamily, I guess, is the question, is why is that the place you landed with all this experience and being able to go in any direction? Why multifamily?
Yeah. And so the reason I ended up in, in commercial real estate in general, and multifamily, self-storage, mobile home parks would be part of that, is honestly, I didn't know this at the time, I will be honest. But what I found out some point into it was that, residential, single family residential, at least in the States, is based on comps. The assessments of the property are based on comparable properties. And so if I bought a $200,000 house and spent 300,000 fixing it up and I had $500,000 in it, but it was in a $250,000 neighborhood, I would probably never get my money out of that, because residential real estate in the States, at least, is based on comparable properties.
Right.
But, multifamily and other forms of commercial are, and I consider multifamily commercial because it's not just, a single family or duplex. It's based on a formula, and that formula is that the value is the income divided by the rate of return. And so if I can increase the net operating income, then I can increase the value. And if I use safe leverage, I can increase the value much more. And so, and then sometimes even shrink the cap rate, the denominator in that equation, I can increase the value much more. Mm-hmm. And so I love that opportunity to be able to get the value adds and to be able to drive, using math, a higher income level, and a higher appreciation. I like both. So I like cash flowing properties first, but the appreciation is obviously a big bonus.
This is great. This is perfect for my next question. So when you're looking now in different real estate markets, what is it you're kind of looking for? What regions do you choose? And maybe we can kind of transition from what you're saying there as well as figure out, do you look for cash flow as the primary factor, or are you looking for equity and high appreciation markets as your primary factor? I'm curious how you go about making that decision as an investor, that not just for yourself, but for a pool of high net worth clients.
Mm-hmm. Yeah. So we're looking for cash flow first, and then we look to appreciation as a bonus. And so we like both, but in general, except for the rare exception, we're looking for properties that already cash flow day one. We're also looking at the debt service coverage ratio, also known as the debt coverage ratio. And to make that real simple, that is the ratio between the net income, not including depreciation, not including taxes, not including mortgage payments, just the net operating income, divided by your debt service, which is obviously principal and interest payments. If you divide that and get a 1.25 or 1.3, 1.35 ratio, again, it's the income divided by the debt, that means you only got a 25 or 35% margin of safety between your income and your debt payments. And so the banks consider that safe. We like to look for a much, much higher ratio. I mean, if possible, it's fine if on day one it's 1.3, if they have a definite plan for increasing it quickly, but it better be real certain or I'm going to be really nervous. We're looking for debt service coverage ratios of 1.6, 1.8, 2.3. Our average right now across all of our 24 properties in our fund is 2.3 debt service coverage ratio. And so that is the kind of margin of safety we're looking for. Now, you asked me about geography. I'm writing a book tentatively called Warren Buffett's Rules for Real Estate Investors. And this book is taking his principles and translating it from stocks and bonds and such to real estate. And we really see him as somebody who finds expert local managers, expert company managers, and he trusts them implicitly. And he doesn't get involved in all the details. In fact, these managers sometimes don't hear from him for a long time. He's only got 26 people in his headquarters, and he's like the 5th largest company in America. And so basically it's very decentralized. Well, we do the same thing. Welling's Income Fund, we look for great operators. We spend a lot of time getting to know them and vetting them, and then we trust them to pick the assets and the geography. So I don't know anything about Medford, Oregon. I've been there to the airport, but I've never, lived there. I don't know the market, but my operating partner does. And so we trust him to pick the geography.
Awesome. And so I would encourage anyone that's interested in looking more into the Paul's portfolio. So it's called Welling's Capital, correct?
Yep.
Awesome. And so you're obviously managing all these portfolios, and the economy is on a little bit of an interesting path right now. So if I were to ask you how, with your portfolios, as much as it's in your purview, has COVID impacted those investments, or what kind of comes next, I guess, when we look at the economy and as you're making these decisions?
We're looking for recession resistant, not recession proof, but recession resistant assets. And COVID has so far not significantly affected any of our assets. We've got self-storage, we've got mobile home parks. We theoretically have multifamily, though, Bradley, we haven't found any multifamily for quite a while that we've invested in. But so far, so good. Now, I really do believe that the government slot machines, did I say that? I'm sorry. I'm kidding. We do really believe that the government money printing presses have kept the kept the dogs away from the door. So we think that when the government payouts slow down, maybe after the election here in November, we think there's going to be a significant increase in problems. And we don't think we'll be immune from them, but the fact that we have a debt service coverage ratio of 2.3, which is 130% margin of safety between the current income and the debt, we really feel comfortable that we're going to be in good shape.
Awesome. Awesome. So as we're talking about the slot machines, how do you expect inflation, generally speaking? Is that good, or is that a bad thing for your investments? How do you view inflation?
Well, I'm not an economist, and I really am concerned more about deflation. I'm concerned that with restaurants going out of business en masse, hotels going out of business, so many problems with resorts, I'm worried that there might be a deflation. And if there's a significant deflation, the possibility that the net income versus the debt payments ratio could be really problematic. Inflation, I think a healthy amount of inflation is obviously healthy. I mean, Warren Buffett says, time is the friend of the wonderful company, the enemy of the mediocre. And so, honestly, time, the reason he says that is there's natural inflation over time, which is typically 2 to 4%. And that is, if I'm just saying, I don't know the numbers, but let's say Buffett bought American Express and Coca-Cola in 1975. Well, the value of the US dollar has gone down 5.5x since 1975. And so just that inflation alone, that is huge. If he bought Coca-Cola, let's just say at $40 a share, well, just being at par value, in other words, if it hadn't gone up or down in real terms, that's $200 today. Well, that looks like a pretty good return, at least in terms of those numbers. But he couldn't have got that if he would have been buying and selling, flipping in and out. Do you know if you miss the 20 best days in the stock market over the last decade, no, 2 decades, if you miss the 20 best days, your return would go down from like 9% to like 2 or something.
I didn't know the numbers. I've heard that concept though, and I love it. Love it.
Yeah.
All right. So you've gone through 2008. You saw far more ups and downs than we saw even up here in Canada. I'm curious what that taught you. If this is in fact what some people think could happen in like any kind of similarity, it'd be interesting to hear from someone who was invested in the market at that time. What did you learn? Like, what's something we should be kind of keeping our ears to the floor about as this is going on?
Yeah. So I was speculating big time in 2006 or 4 through 8. And so I had a whole bunch of non-cash flowing properties. And so I had a massive amount of debt. I went from $1.5 million in the bank to $2.5 million in debt in 08. And so I went into 08 with this really challenging situation with, no cash flow to speak of. And then all these properties, they were waterfront lots at a resort, and all my eggs in one basket. So I learned a lot of things. Number one, I want a nice margin of safety. Number two, I want cash flow instead of just appreciating properties. Number three, I don't want all my eggs in one geographic or asset type. And number four, I really, really want to think worst case. What's the break even occupancy, which is similar to the debt service coverage ratio, just in occupancy numbers. I really want to realize, they say stuff like, oh, it's different this time. There's a book out there called It's Different This Time, where they study, I think it's 13 centuries of economic ups and downs. And of course, every time it was up, somebody said, it's different this time. It's not going to go down the same way it did last time. And I'll tell you what, no matter what they say, as long as human emotions are involved, it's going to go up and down.
So you talk a lot about how you're diversified your portfolio. And I think this is a great time to ask the question for self-storage and mobile home parks. These are areas that you're still kind of looking at right now. Why is this a time for you? And I know you can go on for a while, but why now? Why in those areas are you interested?
So we're looking for recession-resistant assets. And I proved in my book, my multifamily book called The Perfect Investment, that multifamily is recession-resistant. But self-storage and mobile home parks are as well, Bradley. And so self-storage, there's 54,000 self-storage facilities in the US. That's the same as McDonald's, Subway, and Starbucks combined. Wow. And a whole lot of them are owned by mom and pop owners who are willing to sell, and they'd like to move on. Now, mobile home parks, likewise, 44,000 of them in the US. And the vast majority, perhaps 90%, are owned by mom and pop owners, and they're willing to sell in many cases to move on. The cool thing about both those asset classes is if it's a mom and pop seller, you can pay them a very fair price. You can give them what they're worth, and you can you can happily make their day by giving them millions of dollars that they never expected to get. But at the same time, Bradley, there's tremendous upside they leave on the bone. They don't know or care or have the resources to do the upside. So for example, a mobile home park we got with 311 spaces, it's got 50 vacant spaces. Well, a professional operator could fill those 50 vacant spaces and get the value up from like 7 million in this case up to 15 million by raising rents to market level, by doing some other value adds like passing utilities back, and by filling those spaces. That's all pure profit. And when you get pure profit value adds, you can dramatically increase the value of an asset. And so that's why we love those asset classes.
Yeah, and I can see that that's in your portfolio too. So if anyone wants to contact Wellings Capital and look more into some of those investments, I think that's a great place to start. And so before we kind of move off of this idea of where there's deals for 2020, 2021, I want to ask you a question. Do you think that people will eventually go back to these downtown cores, or do you think that this working from home and leaving the main urban centers is a long-term thing? I'm curious just to get your thoughts on that.
I saw a podcast the other day about New York City, and they were saying, now I'm going to sound like the guy I just talked about a few minutes ago, but this time it's different. They were saying seriously, though, that New York has always bounced back. And this commentator was giving a very thoughtful analysis, I think he is from New York, about why it's not going to bounce back this time. And the analysis included the thought that, and you said it a minute ago, and that is, this is the only time in history that people proved they could work from home. My cousin is an executive with Red Hat, which is now owned by IBM. And he said IBM's all working from home. And he said they've proven in this 5 months that they can get more done at home than they can at the office. He was telling me about a Nationwide Insurance, a huge service center there in his hometown in North Carolina, that had just canceled its lease because they don't need to be in the office anymore. They found out people are happier and better workers at home. So I think there's a fundamental shift here. And honestly, when I think about commercial, of course, office is part of that, Bradley. And I'm really, really nervous about office going right down the tubes behind retail, malls, hotels, and restaurants.
Interesting. Awesome. I appreciate your thoughts on that. So, all right. So let's talk about someone who's just starting out, right? You're just starting in real estate. You're trying to figure this out. Um, what are some things that you should keep in mind, especially with everything going on right now? If you were kind of just starting as a new investor right now, what would be some things that you want someone to teach you before they take that step as an investor, specifically as an investor?
Yeah. So, I mean, I don't know in the Toronto area if this would be as applicable, but I would want to learn how to assume someone else's mortgage. Because if there's a lot of carnage, if there's a lot of people out of work, if there's a lot of people who can't pay their mortgage, if there's a lot of people who are defaulting and walking away from their house, well, if I can learn to go to them and provide a solution, hey, your house has been on the market for a couple of years and looks like it needs a lot of work. It looks like it's by this power line. It looks like your realtor took horrible photos and maybe people don't even know what a great house this is. Why don't you let me assume your mortgage? You can walk away with no bankruptcy, no foreclosure, and then we will take over your mortgage. We'll do a little fix up on the house, like paint the front door and cut the grass is what we've done. I remember on one house, we did this years ago. And then we turn it over to a tenant or a tenant buyer. Now, if I can build a whole portfolio of homes that I don't own the mortgage on, the previous seller did, that's quite a feat. And it's possible to get 10, 20, 30 homes or maybe more that you are controlling by paying the mortgage on. But you and when it sells, it will be, it'll go to you. The profits will go to you, but you didn't have to get the debt on it. That's the first thing I would teach a young real estate investor.
I love it. And so we won't dive too far into it. So the concept there, just so that our audience is on the same page, is called subject to deals, which are more common in the States. There's also lease option sandwich that Paul talks about in a lot of his video content. So I'd encourage anyone who wants to learn more about that, specifically how it happens in the States. And if you can, like you're saying, convert it or translate it to how we function here in Canada, then power to you. I think that's awesome. So I've also heard you talk with other questions about this idea of lazy equity, or if someone, let's say, has a home, maybe they have 100% value in their property, they're semi-retired, and they're looking for, is there an opportunity in here for me? How do you look at that? Explain maybe what is lazy equity and what would you recommend or suggest to these people, and how much, what's the loan to value they should leave and all that?
So I don't live in a really hot area, but my house just went up 100,000 in value in the last few years. And so I'm getting ready to refinance, because if there's an extra, let's say $80,000 in cash I can take out and borrow long-term from a bank at 2.8%, I mean, that's really, it's
I would blow
almost
your
free
mind if
money.
I told you the rates we have down here.
I got to hear this. Tell me.
20% down. We've got some advertised in like 1.6s,
Is
under
that
2%.
right?
The major banks are doing 2.1. So
Really?
I laugh when I hear the States talking about mid twos. I'm like, you have no idea.
That's amazing. Well, to me, that's free money. So why not take that money, invest it in notes, invest it in private mortgages, invest it in something, invested in a commercial real estate syndication if you can find one you trust. Loan it to a house flipper at, and make 18% off of it, or could maybe not 18, but I mean, house flippers clearly they can pay you that, especially with the points, or loan it to a hard money lender. You'll get 12% maybe, or go invest in a fund where you'll get 8% or 10 or 12. That is a brilliant and to me a very obvious strategy to do that. I'm not saying go get every dime of debt you can, because that sounds like speculating again, but I would safely consider refinancing or using the equity in your home or other properties to go out and leverage yourself over more properties.
Now, do you like line of credit products, or do you like these hard money refinance type of money? Like, if you were to suggest this for someone in this area, what would you say is probably smarter or more wise?
Well, as far as getting access to the equity,
Yeah, getting access and you being able to use it, like what gives them more control or allows them to take it and make money with it,
yeah, no, definitely line of credit. I mean, home equity line of credit is a beautiful thing. And if I can, finance a property and have a HELOC then I can get the access to the money without having to pay interest every month, because I'm actually, I'm actually keeping it paid down till I need the money. So I get the best of both worlds. There's actually a concept too called paycheck parking, or I believe it's promoted at a website called reverseyourmortgage.com or something like that. Anyway, basically you take all your paychecks, any money you get, any money you make at all, you put it against your HELOC, your line of credit, use it as a checking account, and then keep the line paid down. Well, if you can pay it down, let's say you're getting a $10,000 paycheck every month. Well, if you can chop down your mortgage for 10,000 just for a few days or weeks or months, the cumulative effect of that allows you to pay off your mortgage much, much more quickly than a 30-year. If we have a 30-year loan in the States, it can be paid off in 6 or 7 years just by being creative like that and doing that. Well, it also can be paid way down to where you can get access to that equity. If you don't want to pay it off, just refinance out that lazy equity and go invest it somewhere smart.
I love it. It's got to change that mindset first before you run and do that.
Right.
So for people who, again, back to this kind of first time investor, I think this is a good question I've heard asked in some of your other content that I think is worth having here. Would you suggest someone that gets a property try and kind of manage it themselves, or would you encourage someone to hire a property manager first? How would you usually explain that to someone just starting out?
Taking a property manager on can, eat up a quarter to half of the cost, of the net operating income. And so it sounds really pricey, but the alternative is dealing with toilets, tenants, and trash. And honestly, one deal like that in 1 year doing that yourself can drive you right out of the business. So all things said, I would certainly recommend a property manager.
Awesome. Paul, I think this has been great. I'd love for you to be able to share with us, where could our audience get more information about you? I know you said you're working on a book. Where would you like our guys to find you if they have any other questions or anything like that?
Yeah, just visit our website. It's wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com. I'm also all over Bigger Pockets.
Awesome. Thanks again, Paul. I appreciate your time.
Thanks, Bradley.
Take care.